Hello, Stephen Koukoulas here, Economist in residence with the wonderful Zagga group, and a little bit of an invitation ahead of the economic update, and that is next week on the 12th we've got a webinar, Positioning for 2026. What are the economic signals that are shaping our market? So we're going to be chatting about, well, all of the things that have happened in the last few months, and where to in this really difficult to anticipate year ahead. Now, into the monthly update. Wow, and haven't we had a change of scene in recent times that compared with where we were towards the end of last year? Rate cuts were being priced into the market, inflation was nice and low, things were travelling pretty smoothly, and there was some sort of a pickup in economic activity. Fast forward to early February, well, the Reserve Bank have clearly hiked interest rates. We had concerns coming through in the most recent inflation numbers that some of the services-based inflation was a little higher than the RBA would like. There were some other price pressures in international travel and things. So in its wisdom, it thought, well, inflation is going to be higher for longer, and therefore it decided to hike 25 basis points to 3.85% for the official cash rate. Now, the RBA Governor, Michelle Bullock, didn't really give much forward guidance, as is her demeanour. So we're going to be very much data dependent, as they say, and I don't usually like that phrase, but what happens to the next round of inflation, unemployment numbers in particular, what happens in the global economy will be really important for the RBA deliberations. Now, the other bits of news that have come out on the economy are actually quite good. We've got an economic pickup, so GDP growth's looking to move above 2%. We get the December quarter numbers in early March, and that'll probably, almost certainly, confirm GDP around about 2.25%, which isn't bad. It'll be one of the strongest growth rates that we've seen in a few years. We, consumers, householders, are driving that increase in spending, so the rate cuts of last year probably fueled a bit of a cash boost to our pockets, so we ramped up spending, not super strong, but it was a recovery nonetheless. And the other thing, building approvals. Obviously, we need a construction response to add to supply of dwellings if we're ever going to address the housing affordability issue. And on that score, we've had building approvals, while they're very, very volatile on a month-on-month basis, depending on apartment developments and these sorts of things, the trend is still generally higher, although it's run out of a little bit of momentum just in the last few months. But nonetheless, we're probably in for a better year for dwelling construction in 2026. And again, the government, Commonwealth, state and local, are all trying to fast track new construction, reducing red tape, these sorts of things as we move towards a bit of a construction pickup, which, as I said, is much, much needed. On the unemployment front, well, we had a period of weak employment growth, and again, one of the factors in the RBA's deliberations, lo and behold, in the month of December, plus 65,000 for employment. The unemployment rate ticked down to 4.1%. Might be just a bit of statistical noise. We'll need another monthly indicator to confirm that, but nonetheless, it's good to have lower unemployment. Of course it is. It's a sign of economic health in a way. So in summary, and this is what I'm going to be alluding to in the webinar next week, rates are moving higher, and if inflation continues to track, even as the RBA is forecasting, not even if it's higher than they're forecasting, yep, we'll probably get another rate hike. Probably not two, because that takes rates back to a really restrictive level, well above 4% for the official rate. The economy is improving, which is good news. So consumer spending, construction, these sorts of things in the economy are a positive for us too. And the labour market, well, it's nice to have an unemployment rate nearer 4% than 5%, which is what we've got. So I'll expand on those, have plenty of questions ready for the webinar. Look forward to chatting to you then. All the best.